Hello there, how are you? Good morning, good afternoon, or good evening. My name is Tony Martinez, and in these next 10 to 15 minutes, I'm going to talk to you about a strategy that will show you how to move qualified dollars into an environment where you can now reinvest those into tax-free environments later on down the line without having to take on a 10% early withdrawal penalty and without having to pay the taxes out of your own pocket. And so follow me through this strategy because there's a couple different things in play in order for you to make this actually happen. Before I begin, let me throw out a quick disclosure. Number one, make sure that you do talk to your own CPA, explain to them what you're trying to accomplish. Please understand that none of this is a blanket recommendation. I don't know anyone's or everyone's personal financial situation, and therefore, before I officially recommend this to any single individual person, I would always want to do a meeting where I just fact find and learn what they're trying to accomplish, what their time horizons are, what their risk tolerances are, what their income limit, what their income is, how are they generating their income before I make this as a recommendation. The purpose of this video is to explain a strategy that I've seen very, very, very wealthy people leverage over the years because it makes sense for their particular situation. So I advise you to make sure that this is something that makes sense for you to do before you go about and doing it. And if you'd like to reach out to me or my team, my number is 239-784-1118. I repeat, 239-784-1118. And in my network are estate planning attorneys that can help with estate processing, taxes, trust, probate protection, so on and so forth. I've got CPAs as well too on my team that could help you with tax preparation, whether they're business side or individual side. And so this is a strategy that I've had the pleasure of learning and working with over the last 2 decades that a lot of people have leveraged. And so I'm going to get right into it. In this scenario, we're going to talk about and I'll give you kind of a case study, right? We're going to talk about a client that has, let's just say, $50,000 sitting in either an IRA or a former employer 401k. Okay, this client is 40 years of age. And so one of the biggest worries that they have is if they tap into this money because they're under 59 and a half, they're going to pay a 10% early withdrawal penalty and taxes on this money, right? Now it's an IRA that they can move. It's not inside of an annuity that has surrender charges. And it's in a 401k with an old employer, therefore they can move the money around if need be, right? This also works with 403bs. This also works for any kind of qualified account that allows you to move it or roll it over or transfer it over, okay? So the objective here is how do we get the money out of here without having to worry about that 10% early withdrawal penalty? And how do we do it in a way where the tax bill doesn't get paid out of the person's pocket, right? So this is the scenario. First thing we have to understand is that there is such a thing called a Roth conversion, right? So the first step is we got to be able to take this IRA or 401, and we got to convert it into a Roth through a Roth conversion, right? Now, why is this so important? The moment you move money that's qualified through a Roth conversion, one of your biggest enemies, which is the 10% early withdrawal penalty, is now eliminated. It's eliminated, right? Now, let me explain a little bit about how the Roth works so that you understand. The Roth IRA has 2 types of monies inside it. The first one is your basis. Your basis or your principal is the amount of money you yourself have put into it. The second batch of money is the earnings. Whatever the Roth IRA is making in earnings inside of the policy. Those two are looked at very different from Uncle Sam's perspective. The basis, you got to pay taxes on it as the money goes in. Because you pay taxes on it, Uncle Sam doesn't care if you move the money out. He doesn't care if you take this money out of the Roth and go somewhere else with it, because at the end of the day, he's already collected his bill. The earnings, however, he does care about. The Roth IRA or the Roth 401k states that after you turn 59 and a half years of age, you then can take out the earnings on a tax-free basis. But if you tap into the earnings before 59 and a half, you're going to pay taxes and an early withdrawal penalty. But the basis that you've already paid taxes on, he doesn't care what you do with it. Okay, so this strategy works best when you do it at the beginning of the year. So I'm going to put some months here: January, February, March, April, May, June, July. Oh, sorry. July, August, September, October, November, December. It works best if you do it at the beginning of the year. You convert at the beginning of the year. The moment you convert into the Roth, all of the money that you converted over is considered basis. All of the money you converted over is considered basis. Why? Because the year that you did this conversion, you've got to pay taxes on 100% of that money. So in this scenario, with $50,000 being converted from this to this, now $50,000 is going to be taxable to the client at the end of the year. Let's just say that this was started in 2025. We know that in 2026, by January 31st, they're going to receive a 1099 for this $50,000 that they converted over, and they have until April 15th to make the payment on it unless they file for an extension. So that's kind of easy to understand. $50,000 is now considered your basis. Guess what you can do from this point forward? Instead of continuing through the Roth, you move the money out of the Roth into a non-qualified environment. Meaning, you no longer want this money to be in a Roth or IRA. You're okay with this money now being checkbook money, money inside of your bank account. You've already paid taxes on it. Well, you will be paying taxes on it in 2026. So step one, take your IRA 401k, convert it into a Roth, and then from your Roth, get it out of the Roth into the non-qualified world. The conversion eliminates this. Now we got taxes to worry about. Let's just say taxes are roughly 20%. Well, 20% of $50,000 means that there is going to be a $10,000 tax bill in 2026. However, it's 2025, the beginning, January, which means you got an entire year to invest your $50,000 in this non-qualified world to earn an interest that can help offset this $10,000 bill. Well, what if you could take that $50,000 and invest it into, let's say, a 19% environment? I'm specifically using 19% because at this current juncture right now, we have access to a 12-month vehicle that is earning 19% in a fixed return. Now, 19%, 12 months, so at 12 months you can liquidate, 50,000 at 19% means you're going to earn $9,500 within that 1 year before the taxes are due. Okay? Now, this $9,500 could pay that $10,000, right? This leaves you with a $500 bill. Leaves you with a $500 tax bill, right? So are you using money out of your existing pocket to pay for this $10,000 tax bill? No, you're using earnings from the $50,000 within that 1 year period to pay the tax bill. So you're essentially biting the bullet on earnings for that 1 year period, but at least you're not coming out of pocket to do it, right? Now, this $9,500 that you earned is also going to get you a 1099. Okay, this is also going to give you a 1099 in 2026. It will. So when 2026 comes along, you'll have a 1099 for the 50,000 and you have a 1099 for the 9,500. You use the 9,500 to pay the $10,000 note, the $10,000 tax bill. That leaves you with a $500 balance. If you've got 20% in taxes to pay on this 9,500 as well, that means 9,500 at 20% means you've got 1,900 to also pay in taxes because of the fact that you earned this 9,500. That means your total tax bill is $2,400. If you take $2,400 and you divide that by your $50,000 of initial money, that's 4.8% that you're paying in taxes when you compare it to the $50,000 that you originally started with. And yes, I do understand the money, the $50,000, it earned 9,500. So you're taking that earning, biting the bullet for the year, not using that earning for savings, and you're applying that earnings towards a $10,000 bill that you have in taxes. But essentially, out of your own pocket Outside of what your 50,000 earned you that year, you came out $2,400, which is 4.8% in taxes. Now, if you were adamant about not paying this 2,400 as well, there's something else that you can leverage, especially if you're a business owner. So if you're a business owner, pay attention, because this is a very well-known tax strategy that the Wealth of America leverage. CPAs will talk to you about it all the time. If your accountant and CPA doesn't know about it, make sure you get with one of ours that we have access to that I can refer you over to, and they can easily talk to you about it. But it is called the Augusta Rules. The Augusta Rule allows you, as a business owner, as an individual, as an individual, to rent your home, your place where you stay at, to rent it for up to 14 calendar days to someone else or another business. And whatever you generate in rental income is tax-free to you, but a write-off to the person that you charge. So now, if you're a business owner, Tony Martinez is over here, Tony Martinez's business is over here, okay? If I rent my home to Tony Martinez's business, and let's just say I rent it for $500 a day, right? Whatever the average going rate is of the particular location that I live in, I rent it for $500 a day, and I do this for 14 calendar days, where Tony Martinez as a business will host business meetings in my home, whether it's business planning, whether it's meetings with my business partners, whether it's planning for an event, hosting hosting an administrative meeting, hosting business get-togethers, anything of the sort. I run business meetings through my home. I'm going to receive an invoice from Tony Martinez, the individual. That invoice, as a business, I can pay. I have to pay it. And so $500 a day, 14 days. Let's do the math. 500, 14 days is a $7,000 bill that I write a check for. I can write that off as a business expense. However, Tony Martinez, the individual, can now claim this $7,000 as tax-free income because of the Augusta rules. I don't have to claim that $7,000. Well, in this scenario, I just moved $50,000 into a Roth to avoid the 10% early withdrawal. I then took it out of the Roth and moved it into a non-qualified environment. I then invested it into a 19% 12-month vehicle that generated me $9,500. This $9,500 helped me pay the $10,000 bill that I had because I did this conversion, which left me with the $500 out of my own pocket. This $9,500, however, that I earned also gave me a 1099 of $1,900. So my out-of-pocket cost is $500 plus $1,900, which is $2,400. But I rented my business, my establishment out to my business and generated $7,000 of tax-free income. Don't you think this $7,000 could easily pay this $2,400? Write that off? Of course it can. Not a problem at all. Not a problem at all. What did I just do in this entire, in the scope of this entire transaction? I shifted $50,000 from pre-taxed early withdrawal penalty world into now $50,000 of post-tax, ready to move into wherever I want world. Where can I move that $50,000? Well, what if I move it into permanent cash value insurance? Why? Because the tax codes inside of permanent cash value insurance that were created in 1904 is 7702-A. Though that tax code allows me to earn interest inside of that policy, but more importantly, it allows me to take advantage of a very old advanced markets strategy called the Rockefeller Waterfall method, where now I've put my $50,000 over here, right, in my cash surrender value account, right? I've got a certain amount of death benefit here. Let's just say hypothetically, for the sake of this example, it's $500,000 of insurance. I can tap into this money through a death benefit. Everybody knows that. If I die, I leave this money behind for my family on a tax-free basis. I may even be able to leave this $50,000 as well, just depending on how it's structured. I can tap into this $500,000 as a living benefit if I have chronic or critical illnesses. I can tap into this money. I understand that on a tax-free basis. But one other thing that I could do with certain plans is I could borrow. I could take a loan against my $500,000. And the loan that I take out is the dollar amount that I could take out will be directly tied to the amount of cash surrender value that I have in the account. It'll be directly tied to it, right? But theoretically, right, according to, again, the right structured policy, this is why I tell you, talk to a specialist, talk to an expert, reach out to me. I'd love to help you out. You can essentially drop the $50,000 in, right? And you won't have access to borrow against the full 50,000, but the right type of policy structured in the right way would get you actually about 90% of that accessible to you in a short period of time. So 50,000, 90% of that means that I could take a loan for $45,000 out of my death benefit while my $50,000 is earning an interest based on wherever I put it. If I put it into a whole life policy, I'm going to earn a fixed rate of return based on the dividends of the policy. If I put the money into an index universal life, I'm going to make a return based on the index and the index funds inside of the account. I'm not a big fan of variable universal because that's risk inside of risk management. Not a big fan of that. But essentially, those two strategies you could do. So this 50,000 is going to earn interest in wherever those policies are invested into. But this $45,000 that you just borrowed, these are loan proceeds that I can't be taxed on. So what if I take this $45,000 and I reinvest it somewhere else? For example, what if I reinvested in that same 19% environment that I was talking about earlier? That same 12-month, 19% environment. It's a 19% fixed return with collateral. Now, because I borrowed it, there's an interest rate that I'm paying. What if I told you that I could get that money borrowed to you at 4%? So wait, I'm earning 19 on money that I borrowed at 4. That means that my net return is 15%. What if I take that 15% and I reinvest it back into the policy? And I grow my cash accumulation, which causes me to grow my cash surrender value, which then causes me to be able to borrow a much larger amount the next year. And what if I rinse and repeat that over and over and over and over and over? It gets to the point where I no longer have to continue to make premium payments into this policy out of my own pocket. I could just do it out of the earnings. And yes, although in this environment, I'm getting a 1099, if I have a CPA, I'm definitely finding ways to write a lot of that income off. I'm definitely going to take advantage of the Augusta rules that I just learned a couple minutes ago in this video. But then I'm going to take that money, I'm going to put it back into here. By putting it back into here, I can increase the amount of money that I borrow. And this amount that I borrow is completely tax-free. And it's a loan that I don't necessarily have to pay back because I have a death benefit that'll cover the loan when I pass away, which means I'm borrowing from it in a tax-free manner. And the interest out of it gets covered from the death benefit. And by the way, I don't have to apply for this loan. I don't have to have my credit checked. It won't report on my credit bureau. Why? Because I'm borrowing against my own asset. I've become my own bank in this strategy, right? This is a strategy that I've been able to help thousands of people take advantage of. This is a strategy that when done the right way and not treated as a short-term vehicle, not treated as a get-rich-quick scenario, I've been able to help people move qualified dollars into this world without having the tax implication or early withdrawal penalties. And then from here, leverage death benefit the way the Rockefeller family has been able to leverage death benefit and create this waterfall effect where not only am I going to be able to borrow a good portion of my death benefit and use it for my retirement, but when I pass away, my death benefit will do two things. One, pay off the loan, the principal and the interest, and then leave another big chunk of change to my next family, to my generation that follows me. And if I taught them the right way on how to do this, guess what they're going to do with that money? They're going to do the exact same thing with it over and over. And then that means my son and my daughter will do that for themselves and then leave it behind for their kids. So my grandkids are okay. And if my grandkids learn this strategy, they're going to do the same thing for the great grandkids. And it creates this ripple effect of generational wealth and tax-free earnings. Hopefully this video helps. If you want to learn more, and you want to see if this is a strategy that makes sense for you, and you're like, Tony, can you please show me how I could earn 19% in a 12-month vehicle And in the same token, take advantage of these amazing permanent cash value policies that allow me to borrow against my death benefit and create this a crazy OPM, learning how to make money using other people's money's strategy. Do me a favor, reach out to me. My number is 239-784-1118. Shoot me a message, say, hey, Tony, I just saw your video. I'm massively interested in moving my qualified funds into a non-qualified world so I can avoid this 10% early withdrawal penalty, avoid the taxes from coming out of my very own pocket. I want to learn about how to leverage death benefit as a way I can, make money using the death benefit. And I also would love to learn about this 19% environment that I could do in a 12-month period. Whatever about this presentation struck a chord to you, hit me up, shoot me a message, let me know. Thank you so much. I appreciate the time that you gave me. Do me a favor on the comments. Let me hear your feedback. Let me hear what you liked about this. Bye-bye.